And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's Wednesday, it's hump day, and not a lot to talk about today. So, we'll just kind of muddle through. Danny's going to join me. We'll talk about some financial planning stuff, just teasing. Of course, the election last night, I stayed up late with Adam Taggart, and we had a bit of a Twitter Spaces last night just talking about, the election results coming in, etc. But, it's interesting. Now that this morning, right, we've kind of seen this market shifting back and forth over the last few days. And this morning's before the bell is going to be a little bit longer than normal, so we'll do that in just a minute. But I'm going to spend a few minutes going through a couple of different asset classes because of this. But the outcome of the election is now starting to have some ramifications on the financial markets, not unexpectedly. Going into the election, we kind of saw that risk-off kind of rotation out of the market. We saw money coming out of stocks, going into bonds, etc. That's being reversed pretty sharply not pretty sharply, very sharply this morning on the outcome of the election. So again, with Trump winning the presidency and looks like control of the Senate is going to go to the Republicans, the House is still up for grabs at this point. The last time I checked this morning, it's about an hour ago, so I don't have updated data, but about an hour ago, Republicans had about 196, 97 seats in the House. They need 218 to control the House. So again, we don't have a complete sweep at this moment. It does look favorable for Republicans to take control of the House. We'll see. But that sets up the ability for a lot of these policies that Trump wants to get passed to actually pass them. Now, that may or may not be good, economically speaking, over the next 4 years, depending on what he passes, right? But we'll kind of see what happens. But right now, the market is liking the outcome of the election so far. And let's go ahead and get into kind of the technical overview of the markets. Like I said, there's quite a bit to go through here. So here's what you need to know before the bell this morning. So the election last night now behind us. Trump, the winner of the presidential election. This is sending stocks markedly higher this morning. So yesterday the markets rallied into the election. The market was kind of sniffing out the election yesterday. Last night, futures continued to improve, and as the results of the election became more clear, futures really started to take off. And this morning, the S&P and the NASDAQ are both up about 2% this morning. The Dow's up almost 1,200 points. So they're having a very big jump in the Dow Jones Industrial Average this morning because a lot of the stocks that are in the Dow Jones are more economically sensitive. So the Dow's going to be up 1,200 points, so it's going to be pushing all-time highs today. The S&P and the NASDAQ both are going to have bounced off critical support, and as we talked about yesterday, both the S&P and the NASDAQ held that kind of critical 50-day moving average. They're going to be pushing back up towards previous highs today as well. So very big move today. Now, whether or not we can sustain this all day, that's just going to be the open knee-jerk reaction, right? So traders are just having to pile into markets at the moment. They want to be into stocks at this juncture. And that's putting a lot of upward bias and a lot of upward pressure this morning at the open. Now, unfortunately, if you're not in the market, it's going to be really tough to get in today because all the trading happened overnight. So the markets are going to open up sharply this morning and then probably won't go much of anywhere the rest of the day. I wouldn't expect that anything's possible, but I wouldn't expect this market to open up 1,200 points on the Dow and then be up 1,500 points by the end of the day. That's possible, but most likely we're going to open at the highs of the day, and we may finish close to that level. But this is we'll probably see the high level for the day, and again, we'll kind of check it tomorrow. But we'll probably have seen most of the move today based on this, kind of this outcome. The interesting one is, of course, the Russell 2000, and small cap, mid cap stocks are going to see big moves today. The Russell 2000 is going to be up about 6% here at the open. Again, expectation that there's going to be more pro-economic friendly structures. Now, interestingly enough, The National Federation of Independent Business, that survey that we talk about here from time to time on the show, that is very economically sensitive, and it tends to lean conservative. So that index has been under a lot of pressure. It was previously, at some of the lowest levels on record, well into recessionary territory. It's been that way for the last couple of years. And this morning, this change in the election status, I would expect to see that NFIB report when it comes back out at the next reading is going to have a big surge. It's going to have a very optimistic take on the outcome of the election, as the extension of the Tax Cuts and Jobs Act is going to get enshrined, maybe some lower corporate taxes, that maybe that comes down the road. There's not, and we'll talk about that with Danny this morning, there's not a lot to happen on the tax front, like in terms of big changes. It's going to be the continuation of those policies that are pro-business friendly. Now, why do I bring this up relating to the small cap? There is a very high correlation between small cap, mid cap stocks and that NFIB index. If you look at the annual rate of change, it's very highly correlated. So if we start to see a very big improvement in the NFIB index, that's going to suggest that we're going to continue to see improvement in earnings in small cap, mid cap stocks under economic policies heading into next year. Now, I will caution you on this. You still need to be wary of small cap, mid cap stocks for two reasons. One, interest rates are still elevated. We'll talk about bonds here in a second. That weighs on their refinancing, and a lot of these companies are non-profitable. So again, while we may see a knee-jerk reaction and a move higher in small cap, mid cap stocks, this would not be an area I would overweight in my portfolio, and I'd be selective if you're buying stocks. Individual stocks in the small cap, mid cap space. Make sure you understand the balance sheets, right? So you don't get in trouble. But again, right now, very bullish setup for small cap, mid cap stocks today. Very bullish setup for the markets in general. And as we talked about yesterday, the issue with, or I shouldn't say the issue, but what's going on now, in particular with the S&P, is that as we push out here, we have this kind of rising trend line that we've had going really ever since, and I'll get my screen to work here, thank you. We've had this rising trend line really since back in August, coming off those August lows. That rising trend line intersects right at 6,000 right now. So the expectation is that this market is going to rally and start to trade up through year end towards our target of 6,000, could be 6,100 by year end. And again, the support for that rally is all coming from stock buybacks, now in particular, performance chasing. A lot of managers are on the wrong side of the trade at this point. They're lagging in performance. They're going to have to play catch up. And with this move today, this is really going to put a lot of pressure on managers to get money allocated to markets here over the next 2 months, because they have to have their performance in place for year-end reporting. This is also going to drag a lot of retail money into stocks today as well. So look for stocks like meme stocks and other issues like that to start performing well also. Outside of that, the dollar is rallying extremely strongly today on the back of the news, and we're seeing the dollar is going to have a very big pop this morning, and that's going to be moving higher on expectations of stronger economic policy here in the U.S. We're also going to see the VIX drop sharply this morning. The volatility index has been hanging up around 18, 19. That's going to open at 15 this morning. So it's going to have the volatility index is going to be absolutely crushed today on this news. And lastly, of course, we are going to see interest rates move up today. This is going to be one of the issues that's going to kind of have people worrying, but interest rates are going to pop to about 4.4% this morning on this rotation out of bonds into stocks, shorting the VIX. So we're coming out of that safety trade into the risk trade today, at least. I wouldn't expect this rally to last much longer in yields. We got very, very oversold here on yields back in June, September. We talked about that being a very oversold condition, and that we'd like to see a buy the rumor, sell the news issue on the Fed meeting. We have now reversed that. We're extremely overbought here. So be a little patient with bond holdings. They'll still be working fine into the end of the year, but today is going to be a big rotation in assets across markets. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff for more of the Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partner to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me. Good morning, Danny. How are you?
Hello, good morning. Great.
Good. So a couple of things is that, again, seeing kind of a very, as I was saying, just going through kind of the various markets, seeing a very broad rally in assets today. Don't forget that we saw this exact same type of rally back in 2016 when President Trump was elected the first time around. We saw a very broad market rally, and then you can kind of see what happened with stocks after that. Now, the difference between now and 2016 that we have to, bring back into account is that in 2016, 2017, the Fed was hiking rates, not cutting rates. Second thing is that taxes were a lot higher. And, of course, in late 2017, Trump enacted the Tax Cut and Jobs Act, which lowered the corporate tax rate, lowered household tax rates. That is actually that bill, those tax cuts are set to expire this coming year in 2025. So in 2025, that act will, and so
2026 it is. Expires at the end of 2025.
Sorry, thank you. So in 2025 that expires, and so all those tax rates, if it's not extended, will revert back to the previous rates that they were before. So that would be a big tax increase for both households as well as corporations at the end of next year. So part of what the market's rallying on today is that those will be enshrined. So those will become permanent tax cuts now going forward. The problem, though, is that while we're all excited about enshrining those tax cuts, we're not getting more tax cuts. Now, it's potential that we'll see, things like no taxes on tips. We'll see those are minor. There's, if you take a look at the number of workers that work for tips, they're a very small percentage of the overall population. So that's not going to be that's not going to move the needle a whole lot in terms of creating economic activity. So while, we're getting a nice strong rally now, the extension or the making the tax cuts permanent, it's not going to impair anything, but it's also not going to provide a huge boost economically because you're not changing anything. We're not providing more tax cuts at this point. Now, it is potential that he's going to try to push for lowering that corporate tax rate to 15% from 21%. that might move the needle a bit, and we'll see if that happens. But then that may be offset by tariffs and other issues. So there's going to be a lot. So my point is be careful. Today's rally is very good, but there's a lot to come, right? There's going to be a lot of economic data to deal with. The Fed is, and I apologize yesterday, I said the Fed was going to cut rates today. It got delayed because of the election. They moved the meeting. So the actual FOMC announcement starts today and the actual announcement is tomorrow. So the Fed will cut rates tomorrow.
Well, it's tricky. They usually do Tuesday, Wednesday, and now they did Wednesday, Thursday. So yeah, it's
exactly.
Easy.
So I got confused.
But all these policies and things that we're talking about, I think, are great. Now the issue is going to be what is the overall impact to the economy? And so Tax Foundation, a bipartisan kind of a tax group, estimates that it's a 0.8% increase in GDP. Mm-hmm. If these things are done, the tax proposals that Trump has talked about. The Individual Tax Cuts and Jobs Act permanence adds 0.5. And it also adds 795,000 jobs to the economy. So there are some good things here. Now, my concern, the things that we've talked about previously, has been that what is the overall impact if he can get more tax cuts done? And really what he hasn't been talking about is the individual side. He's talking about more making that permanent on the corporate tax rate, bring that down to 15% from 21. That would be great, but we're not going to see as big of a boom from the economy in the sense of what we saw back in 2017/2018 when really, we saw corporations, Q2, Q3 of 2018, we saw some of the best earnings we've ever seen, in 2 consecutive quarters. But yet, the interesting thing is that's when Powell comes out and says, hey, we're going to hike interest rates. And we also saw the worst fourth quarter we've seen since the Great Depression.
Right.
So a lot of moving parts here and things that we have to be considering. Also, it's going to be contingent on what does the House and the Senate look like. As of right now, this could be a Republican sweep where you do have that red wave. We've talked about how gridlock is typically good because not as many things can get done. That may change this a bit. They may have a lot more flexibility to get things done if you see that done where, you have the president in the White House, you have a Republican Senate and House. These types of things are easier to accomplish.
Mm-hmm. Yeah, absolutely. And again, trying to get these things passed through, we then have to evaluate what the impacts are going to be on economic growth. And so you got to kind of look at each individual policy as it comes down the pike and then start making analysis. Right now, he's got a very broad canvas. I want to, through his campaign, he's made lots of promises and has talked about lots of policies that he wants to do. But the reality of those getting passed and getting them done is an entirely different thing. And again, we hear lots of campaign rhetoric, and that's fine.
Yep.
That's because they're on the campaign trail. What actually happens when they're in the White House is a very different thing because the economy is doing something that needs attention. Or, I have this idea that I want to pass this particular type of issue, but I can't because now I'm sidetracked because of some other issue that's happening. And so these things don't occur. And that happens all the time.
There will be many of them. So, like right now, I know lots of questions around interest rates. Interest rates have gone up considerably. Lance, you and I have talked about this. I know you and Mike talk about it often. And a lot of the thinking around that, I think, is tariffs to some extent. Now, some you just mentioned that, rates got overdone really quickly. We're going to see them bounce around. We've talked about this for some time. We still think they're on the descent over time. But the tariffs, they suggest it's a negative 1.3% if we impose a universal 20% tariff on all imports plus additional 50% tariff on imports from China. So when you look at these numbers, and if you can accomplish a number of these things or a lot of these things, you still see economic growth. But do you think that that's a big part of why rates are jumping a little bit higher? Do you think it's just a risk-off trade that
it's just risk-off. I mean, we saw people jumping in, and I get a lot of comments, and I saw one in the chat a few minutes ago about fiscal dominance, which is, if you don't know what fiscal dominance is, fiscal dominance occurs when a country's debt and deficits are so large that they can't control inflation through monetary policy. That's not an issue for the U.S. First of all, debts and deficits in the U.S. are not that large relative to other countries. And as we just published last Wednesday on the website, Michael Leibowitz did a great job going through the fact that we import deflation from the rest of the world. And there is no inflation growing anywhere. Europe, China, Japan, They all have deflation, disinflation. We will import that into the U.S. So there is no inflation to import. And as the U.S., the way we operate, because we offshore our manufacturing to a large degree for wage control more than anything else, we export inflation, the cost of wages, to import deflation, lower prices of goods and services. So we don't have an issue with fiscal dominance. That's bear porn that's running around. It's a very bad thesis, and it's not an issue. Yes, the Fed can control rates, and they will control rates. And rates right now are in line with where economic growth is and where inflation's running. So, as inflation continues to decline and as economic growth slows, rates will come down. Now, we're not going back to zero unless you have a recession or a financial crisis. Right. So, and if you're worried about that, then bonds are where you want to be because rates will be near zero at that juncture. But yields can only rise so much on income because of debt service, et cetera. And at some point, and again, we just saw this previously with Silicon Valley Bank when rates rose previously, we had regional banks getting a lot of pressure because of collateral. The Federal Reserve will step in. And remember, the Federal Reserve is still selling debt. They are not buying debt. They're doing QT. They will reverse that policy. They will start doing QE. They will cut rates to bring the long rate down to manage the collateral expectations of banks to make sure we have fiscal solvency, or financial solvency through our banks in the country. So that's just a function that will happen. But a lot of that downward pressure on rates is just going to come from economic growth returning to normal, unless President Trump comes into the White House and says, we're going to do a massive infrastructure build in the U.S. We're going to rebuild our power grids. We're going to start nuclear power plants. We're going to start drilling like crazy, and we're going to invest a ton of money into being energy independent, all right, across all platforms. And the government is going to start investing hundreds of billions and trillions of dollars into those infrastructure projects. That creates a very broad swath of economic activity, creates a very big surge in wages, a very big surge in employment that will lead to inflation. And that's okay because you'll be running economic growth between 4.5% to 5% a year. So interest rates will be 4.5% to 5%.
Well, and you see wage growth.
Yeah. And you'll see wage growth keep up with it. So it's all fine. Inflation's not a problem as long as wages keep up with it. Right. Inflation's only a problem like in the 70s when you had a spike in inflation because of the oil embargo, but wages didn't keep up with it. Right. Yeah. That's when it's problematic.
Well, the last 4 years have been problematic.
Right. Because of why?
Because we didn't see wage growth. But we also didn't have that. No, we didn't have natural growth either.
Exactly. The whole point was you had artificial stimulus that created the inflation spike, and there was no reason for wages to keep up with it.
Yeah.
Right. So anyway. We've been through this conversation a million times. It's all on the website.
Sounds like a broken record.
I know.
But this is what everybody wants to talk about right now, right?
Learn some economics, people. All right. Come back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
One thing that the consumer confidence measures, is that correct if I say consumer confidence measures? Measures.
Squared.
How many measures can the consumer confidence measure? I don't know.
The Real Investment Show podcast.
Dr. Seuss.
The consumer confidence measures investor sentiment about stocks. That's the highest level on record.
Same show, your schedule.
It's amazing. Consumers are super confident about the stock market.
At realinvestmentadvice.com.
At the same time, they go, my life sucks economically, but the stock market, it's all good.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Off-air conversations. Oh, good stuff. All right, welcome back to the show. So, all right, so just going through a couple of things. Again, just because the whole point is look, today the markets are going to go crazy this morning. So just, the best thing to do is just don't do anything today. If you try to chase it today, it could completely reverse itself tomorrow for whatever reason. Just be careful is the whole thing. And again, we've talked about for a while to be allocated to the markets, continue to manage risk, take profits, those type of things, rebalance your portfolio. There was no reason to be out of the market. As we've said before, we're moving the seasonally strong time of the year. That seasonal buy signal is in. Today's rally is going to convert the short-term sell signal likely back into a buy signal. That will put us on track for, we've had this nice correction over the last couple of weeks. We de-risked going into the election like we had talked about previously. So now coming out of this, we're going to start re-risking going into the end of the year. So, but there's going to be some bumps along the way. We've got a lot of things coming up. So we've got the Federal Reserve tomorrow. They'll cut rates by 25 basis points, but they could very well say right now that maybe they're done for the year. Right? That would potentially disappoint the markets, which are still expecting more rate cuts. So there's risk there. There's a lot of risk to economic data going into the end of the year. Retail sales, holiday shopping, holiday employment, all those type of things could disappoint because we are kind of late in this, kind of this post-stimulus spurred economic cycle. So a lot of that money that was all printed temporarily to, provide stimulus checks and, support for this and child tax credits and all these other things. That's all done for the most part. The Inflation Reduction Act, most of that's been spent. There's still some of that sitting out there, and we're still seeing some of that money come in, but there's not any new spending bills on the table. And I think that's the one question that, Danny, we've got to try to figure out is that, under a Trump presidency, is there going to be any more big spending bills done? There's a lot of concern, by people over the debt's currently 120% of debt to GDP. That's not huge relative to the rest of the world, but it's certainly elevated, right? And certainly, at 120% of debt to GDP, you're going to clip 1% off GDP growth, potential GDP growth because of that debt. The deficit's certainly fairly large. So, this is certainly a concern of a lot of conservatives. And if Republicans have control of the House and the Senate and the presidency, will there be a reduction in spending, or will there be some more spending bills? Because that's going to be the real driver for economic activity going forward. If we have big reductions and cuts, and let's just as an example, they were talking about hiring Elon Musk to be the head of the government efficiency office, and I was doing a Twitter space last night with Adam Taggart, and this is one of the questions from a government employee, somebody who actually worked for the government, says, well, if Elon does this, do you expect big cuts? Well, you have to remember what he did at Twitter. He walked into Twitter and fired half the staff day one.
Well, that's the
right?
economic risk I think that we face is
Yes.
that what happens if it's not something where they're staggering this out and it's saying, hey, we know exactly what we're doing. They have their transition team ready. Their transition team's been in place. Trump's been paying for it out of pocket, evidently, for some time. So I've got to think they've got a pretty good idea and handle over what they're trying to accomplish here. And if he comes in and says, hey, we cut half just like he did at Twitter, that economically could spark some issues.
Right. And that's my point, is that, this isn't just clear sailing for the markets.
No.
The whole point is there is risk. And, policies are great. And a policy can be a great policy, but have a negative short-term effect. Right.
But the key thing will be so that negative short-term effect, right? So everybody's saying, and I'm seeing you guys in the chat saying, okay, well, is a recession, is that off the table for at least another 4 years, potentially? But this could cause a recession. Now, we could argue that this may be a well-wanted and needed recession. The issue will be is that you have a ton of people out of work. Are they able to spur the private industry enough that they can pick these people up, and there's going to be other economic, like you mentioned, is infrastructure going to be there? Is there going to be a place for these people to go to have a job that aren't going to be relying on the government? Right. That's going to be key. And, you talked about Silicon Valley Bank earlier, where you get yields near 4.5%. That has been kind of the mark where we've seen that, you could have potential trouble.
That's right.
So there could be other issues out there for the moment that may be momentarily, and longer term, we're still on the upward trend, whereas you've mentioned we're in that bull market trend, about to hit a buy signal. Now, the key here is, I know a lot of you are out there saying, oh, shoot, wake up and you see this. This could have gone the other way. We've talked about, we were talking about at the beginning of this week, we could have a crystal ball that tells us exactly what's going to happen with the election, but the market could have gone totally different directions, or we could still be waiting to see, and the market's just saying, oh, shoot, what's going to happen here? Whereas I think everybody was maybe surprised that we actually got the information as quickly as we did because of the last 4 years ago, and they've been putting it out in everybody's head that this is going to take some time.
Yeah.
Obama came out yesterday and said, "Well, guys, you got to be prepared. It could take a
few
days, weeks, months."
But and look, and if and this goes back to kind of the issues of polling. The polls had the election very, very close, and it was still a close election, right? It looks like right now, again, all the votes aren't in. We don't have Arizona, we don't have Nevada, we don't have Michigan. There's one other state I've drawn a blank, but there's like 4 states that don't have their results in yet. But it's right now it looks like President Trump won by about 2 million in the popular vote. So if we had wound up in a situation like 2020 where you had one winner of the popular vote, one winner of the election, 2016, between Hillary Clinton and Donald Trump, where she won the popular vote, but he won the Electoral College, that would have thrown this whole thing into turmoil. So there was that risk. But fortunately, this came in strong enough that there's not a lot of debate about it at this point anyway. And again, we're not done yet. They're still counting votes. There's still a lot of stuff going on. Not saying that this is going to change dramatically, but we've still got a couple of days to figure out, for certain what all is going on. But I think the important message here, though, is that, policies are good, and, the things that we need to fix have a negative ramification, right? So, again, one of the policies is, hey, we need to fix immigration. Well, that can have a negative short-term impact on the economy, fixing that problem. And what I was telling Danny early this morning is the one thing that the Trump administration needs to work on very hard is very clear communication, saying, look, we're going to reduce government. Robert Kennedy is a very big proponent of getting rid of government agencies and returning them back to the states. And that should be the case, right? Your state, whatever state you live in, as you're listening to the show from right now, if you're in California, you should be in control of your own education, your own energy policies, your own healthcare policies. Same thing for Texas, same thing for Florida. That's not the government's job. That's the state's job. So if we start returning those responsibilities back to the states where they belong, that could cause a lot of short-term disruption. So the administration needs to be very clear, saying, hey, we're going to do this. This is better for you long-term. This is better for your state. This is better for you to control your outcomes, but it's going to cause a good bit of economic upheaval. This is going to put us in a recession. If we reduce government, the size of government, the last several employment reports have been all driven by government employees. Right. The last report, if it hadn't been for government employment, we would have had a negative print in the employment data.
Yeah, but do these people go work from the federal to the state now, right? That could be the case, too.
If states are hiring, right?
Correct.
You've got a lot of hiring in government. But that reduction in staff is potentially recessionary for the economy. So you're going to see a big reduction. So the point is you've got to be very clear about communication, saying, we're going to do this. It's good for you long term, but it's going to cause some short-term pain. And for the markets, that's going to cause some problems too. So again, don't think my point is just be careful. This is not clear sailing from here for the next 4 years. There's going to be some bumps along the way, and we've got to manage that risk. So this is not going to be just, easy sailing for 4 years. Just throw your money into an S&P index fund and don't worry about it. There's a lot of good. If some of the policies are passed, it can provide a lot of good economically for the country. It'll be good for the markets, but it's not going to be just easy sailing.
No, but keep in mind, if you woke up this morning and you thought, oh my gosh, the market is up, this could have gone the complete opposite direction. Don't have that FOMO surrounding this. Understand yourself, your risk tolerance, your objectives, what you're trying to accomplish. Look, this is certainly positive for markets at the moment. I think we can agree that it's probably positive for the markets through the end of the year, and then we'll have to see exactly what they're able to do and accomplish. But there's a long time between here and there, and a lot of things will change.
Right, and there's a really great chart out this morning showing that the kind of the normal averages of what occurs after an election. And you typically have a rally into year end. After the inauguration, markets tend to sell off and consolidate a bit to about June or July. And then you have a rally into the end of the year, the first presidential election year. And the reason for that is A, the markets are working off kind of the exuberance of the election into inauguration. So you get a bit of a sell-off there. But also, too, this is where the rubber meets the road. You've got the first 100 days. You don't know what's going on. There's going to be a lot of policy announcements, and markets are going to have to digest all that. So, again, I would definitely expect a rally into year end. You want to be allocated for it. Just be careful chasing it at the moment. This is going to be a very big up morning right now. Dow futures are up 1,300 points. The S&P is up 2.25%. The Nasdaq's up 1.5%, and the Russell is up 6%.
Well, and if you have to get in, have an exit strategy.
Yeah.
Know when to hold them, know when to fold them.
Yeah. Buy a little today, buy more on a pullback. Work your way into it. So there's another option. All right, quick break. We'll come back. Get ready to wrap up the show. Dane's got some other stuff. He wants to talk about financial planning or some boring stuff. So we'll cover that when we get back. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. All right, just getting ready to wrap things up. Again, just, the whole point of the conversation this morning is, we now have an election result. Like it, hate it, doesn't matter. The important thing, though, is not to start making assumptions based on your bias, right? The market is what the market is, and it doesn't know whether you're a Democrat, Republican, whether you like the election, you don't like the election outcome. It doesn't know that. It all reflects back to economics and ultimately investor behavior, investor psychology. So, our job is to make money. And like I said yesterday, we've got about 6 years to make all the money we can make before we hit the next secular bear market. And that's just a function of averages of time. And if we look back at when this bull market started back in 2009, following the financial crisis of 2008, we got about 5-6 years before we get to the next secular bear market cycle. And that will come for a whole variety of reasons. But just we need to be aware of that. So, again, don't let your politics affect your investing. Just understand what this election means, what it means for policy, what it means for economics, and then we'll just have to adapt as we start to find out what these policies actually are. And again, as I said earlier, one of the big drivers is going to be whether or not there is another big spending bill passed, whether it's an infrastructure spending bill or whatever it is. If that's passed, that is a game changer, for debt, for bonds, for stocks, et cetera. So we'll have to adapt to that. If there's big government cuts, that's a different outcome. And so we're going to have to adapt to that. So don't, what you're going to see over the next couple of days, actually for the rest of this year, is you're going to see a ton of stuff coming about how, this is going to lead to the collapse of the currency. The dollar is rallying strongly today because why? Because economics-wise, we're still the strongest country globally in terms of economic growth, so that attracts foreign capital. So all these stories about de-dollarization hadn't been a thing, right? Over 70% of all SWIFT transactions occur in U.S. dollars. So that's nonsense. Throw it away. Start being selective about the stuff you're watching and make sure it has a strong economic and fundamental bias to it.
Yeah, I think that's important to kind of keep in mind as far as, taking the emotion out of it. We know how many people that when Obama got elected, they were like, I'm out. I'm not dealing with this.
Yeah, they
It's
didn't
gonna
come back
terrible.
for 15 years.
Yeah, I mean, we had calls up until about a year or two ago like, hey, I've been out of the market. I think it's time to get back in. They're like, whoa, I don't know. And that's the problem with this is that we've talked about this often, that we want to rationalize everything. And sometimes markets are just going to do what they're going to do. Sometimes there's just momentum. There's a lot of different things that are coming out, and sometimes monetary and fiscal policy that nobody accounted for pops up, and it changes the game a bit. So we've got to be able to take a step back and understand that, hey, our personal feelings may not matter. And same with Trump. We knew people that got out with Trump. You can remember the media said that he's going to be, terrible for the markets. He's the unknown, and it turned out to be the opposite. They were even going with that narrative up until just recently. That if Trump's elected, he's the wild card. Well, I don't know how that's the wild card. I think we knew a lot about him and a lot about her, to be honest. That if she got elected, it's business as usual as far as what's going on, at least momentarily. And then the same thing for Trump. We have a pretty good idea. He's been very vocal on his stances on many things, and not a lot of it's changed. And I think some has changed, but I think that when you get into a job or position like that, and you see maybe these policies weren't as good as they should have been, I think that it's smart, it's thoughtful. Yeah. You need to be able to take a step back and say, okay, you know what? We did the SALT tax, where we excluded a lot of that. Bringing it back may not be a terrible thing. But like you said, a lot of this is just rhetoric.
Yeah. And again, there's issues around, we've had remember back when Trump was first elected, we were going to have your income tax was going to be on the size of a postcard.
That was a Kevin Brady deal.
Yeah. And that never went anywhere. Right. And again, this is also the problem. And we talked about this at length last night, Danny, with Adam, is that you have to also remember one thing, is that love it or hate it, Congress and the Senate is still very much controlled by corporate interest. They're the ones that write the bills. Right. They're the one that fund the bills. So let's just, I'm not saying any of this is a matter of fact, but let's just take an example, right? So President Trump wants to issue a policy. We're going to increase tariffs on China by 600%, right? Well, if that's really not in the interest of most corporations, again, I'm not saying this is the case. I'm just using this as an example. If most corporations line up and say this isn't good for us, they will fund campaign donations to all the Republicans they need to funnel money to in order to get that bill defeated. And we see this happen all the time. So again, this is why I want you to be really careful about policy objectives versus policy reality. Those can often be two very, very different things. We hear a lot of great things, a lot of rhetoric during campaigns. What comes to fruition typically is a far smaller percentage of those types of issues. Danny?
I'm just trying to follow the chat here. Trying to follow the chat. And you guys are you're on fire today as usual.
I know. By the way, we've got 938 people watching right now. Could y'all hit the like button for us? We'd appreciate it. So, but anyway, look, at the end of the day, Danny, this is, when we're looking at the outcome of all this, again, I can't go back. There's going to be a lot of emotional swings today in terms of the markets. Just be cautious right now. And again, it'll be fine. It's all going to work out fine. I would try to figure out a way, if you're not allocated to the markets, try to figure out a way to get yourself somewhat allocated. We're going to have some dips along the way. But if we do have pullbacks, they're going to be very short-lived. There'll be a day or two, maybe 3 at the most. Buy those dips until we get into early December. Now, early December, between the first and second week of December, really, actually, I should say the first and third weeks of December, mutual funds have to make their annual distributions. Historically, we generally have a pullback in the markets within the second to third week of December. And then you have your traditional Santa Claus rally, which is the last 5 days of the year. That's because all the portfolio managers have to allocate their money to their portfolios. They have to be fully allocated relative to their guidelines, and they want to make sure they own all the right stocks for their year-end reporting. So you're going to have a big move right there at the year end. This is why it's called the Santa Claus rally. It goes through the last 5 days of the year and the first 5 days of January. So that's the so-called first 5 days of January effect. You typically have a lot of allocation there. But again, also expect that we're going to have some pullbacks here along the way. So if you're not allocated to the markets, use those pullbacks as an opportunity to get some allocation to markets, and particularly as we head into the beginning of the inauguration around the 20th of January. So, all right, I think we beat that enough.
No, we have. So, great question though is somebody asked, should you sell out of bonds at this stage, right? I mean, we've seen bonds whipsaw all over the place. We've been as low as about 3.5. We've been as high as about 4.5. That's almost where we are right now. 5% if we go back a little bit further on 10-year.
Look, I think that question's really easy. If you're having a lot of angst so you own bonds, right? We own bonds for two reasons. We own bonds because we run models that have a bond allocation sleeve to them, right? To hedge risk, whatever it is, but we run a 60-40 allocation, an 80-20, 70-30, 60-40, 40-60. And so those portfolios have to have bonds, right? Because that's the allocation to them. Now, the allocation to long duration is fairly small in that 40%. It's about 10% of the portfolio. The rest of it is very, very short duration in cash. But if you own bonds in your portfolio and you're just up at night gnawing at your stomach and not sleeping, sell your bonds. You can always buy them back later if you want them. But if they're hurt, if they're psychologically just weighing on you and it's making you miserable, don't worry about what we're doing. We manage portfolios for very specific purposes. And we have very long outlooks on what we're managing money for 20 and 30-year periods, not a week or two. So if you can't stand the volatility, sell them. It's okay. It's okay if you sell your bonds. It's fine.
Well, and here's something else to think about, though. If this is in a taxable account, you may, and you're at a loss, like let's say you bought them a couple weeks ago, rates were much lower, and you can sell them at a loss.
Tax loss harvest.
Tax loss harvest, right? I mean, so we're having a challenge finding a lot of positions that we could actually sell to offset gains. So this is one of those years where it's great. And I think that if you can utilize something like that, and maybe you still have a conviction in bonds, and let's say you are in the ETF, go buy an individual bond if you want to flip back into something else. You just have to understand the wash rules and understand that 30-day time frame so that you don't disallow that loss. There's other ways you can change investment vehicles and still accomplish the same type of strategy here. So that's just something to think about. But I like what you said. If it's something that keeps you up at night, you don't sit well with it, okay, great. I think the thesis is still the same. If we have rates that are too high for too long, number one, we're going to have an issue with economic growth. We, like you mentioned, Silicon Valley Bank, that could become a problem with creditors, with financial institutions. And then, for growth, that weighs on growth. So if we see rates lower, which President Trump has talked about many times that he wants these interest rates lower. Now, how do they get there? Who's going to be the next Jerome Powell? That's the question, right?
Yep.
And what type of, how much play or oversight is Trump going to have on this? We know they have a lot. He's done so in the past. That's going to be a big deal.
And look, and by the way, if you're trying to generate a 6% return in your portfolio, and I can buy a 10-year Treasury note today at 4.6, 4.7, that's a huge chunk of my 6% annual gain already done just from the interest income of the bond alone. So also don't forget that bonds mature and they pay interest income. And if you're trying to generate a fixed rate of return in your portfolio, bonds are hugely helpful, particularly if you can lock in these rates, because they're not going to stay this way forever. So if you can lock in these rates, that's a huge chunk of your total return already built in the portfolio. Tomorrow, Michael Leibowitz joins me. We'll talk about the upcoming Fed meeting. We've got to talk about gold. We've got to talk about a lot of stuff with him tomorrow. So that's all coming up on tomorrow's show. We appreciate you being here very much. Be sure and hit that like button for us. Have a great day. We'll see you back here tomorrow on the next Real Investment Show.